it's very surprising to me that the premiums have come down. They've come down literally 2 weeks in a row.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics and our weekly physical silver retail report with Andy Schectman of Miles Franklin, where dig into the conditions in the physical silver market each week and also some of the things that are going on in the world, which seem to be getting a little bit chaotic these days, although somehow U.S. keeping it together for the time being. No bank failures this past weekend, which I think in net is certainly a good thing. Still a lot of concern about many of the things going on out there, which we'll dig into today. So to join me, as always, is Andy Schectman of Miles Franklin. So Andy, how are you today? And good to have you on.
Great to see you, Chris. I'm well, buddy. It's good to be back.
Well, appreciate you making some time as always. And perhaps we could start with something that we do like to cover each week, which is just what's going on with the premium levels and product availability. Just a quick recap. We had things settle down somewhat earlier in the year, then get a bit chaotic again during the bank failure months. As of last week, had settled back down again, and curious what's happened since then as we start a relatively quiet trading week, at least one day in. But how's everything looking with the premiums and products?
It's really almost schizophrenic, Chris. Like, people have such a short-term memory, I guess, nowadays, that um, what happened during the bank failures a few weeks ago is already a distant memory. And it's very surprising to me that the premiums have come down. They've come down literally 2 weeks in a row. The availability is very good, better than I would have anticipated. And when you look at all the chaos around us, when you look at the potential with the debt ceiling limit just a few weeks away, and Janet Yellen saying that if indeed the banks do, or that they aren't able, rather, to come to an agreement on the debt ceiling, that dozens of banks will fail. She said that. And when you look at a almost 6% yield on the 1 month treasury, when you see the credit default swaps on the treasury market going through the roof, I mean, you have the most sophisticated traders on the planet telling you that there is going to be, almost with 100% certainty, a technical default, that they are not going to come to an agreement on the debt ceiling, the Republicans and the Democrats, and that there will be a default. And how long that goes for, I guess, is open to that's open to discussion. But when you see the default swaps as high as they are, it's telling you there's going to be an impasse, and they're going to shut down the government for a period of time. And that's why, if you're feeling lucky enough and you want to get almost 6% on a 1 month treasury, you can do that. But what happens if the government closes the door? You're not going to get paid on that, at least until they reopen somewhere down the road. So anyways, I think it's a very, very, very interesting time. And there are so many things, that warning signals people should be aware of, and yet they're just walking, right past them, and it's business as usual until the next event happens. And that's one of the things that's always driven me crazy about the public. And it's also one of the things that I think the public has a hard time. Those who listen to me talk about things like an environment which will be defined by the inability to source product. They look at right here what's in front of them, and they don't see it. I don't look at that. Like, when you're skiing, if you look at the tips of your skis, you end up crossing them and wiping out. A good skier looks 10 to 15, even maybe 20 yards in front of the skis. Never looking at the tips of the skis. You have to see what's coming at you. And if you don't see what's coming at you, you can't get out of the way. And there are so many people that aren't looking at what's coming directly at them, and they're only focused on what happened today and what happened yesterday. And their memory is not strong enough to say to them, hey, these are warning signals, and they keep happening with greater frequency and severity. We got a debt ceiling debacle that is just a few weeks away. We have fragility in the banks. We have rates that are so high in the money markets, courtesy of the reverse repo market, that there's no reason to stay inside of these regional banks, which are bleeding deposits. And you see an event where all of a sudden there is a spark again of concern in these banks. And you will see, I think, blood in the streets. You will see people wake up again to, hey, this problem isn't behind us. In fact, it's just beginning. And I truly do believe that this problem, not only by design, is just beginning. And I do think it's by design. I truly do. The Fed is aiding and abetting the exodus from these banks by continuing to allow the money markets to invest in the reverse repo market. And by the way, this isn't just the regional banks. If you look at the money that's bleeding out of the commercial banks, everyone is chasing yield. The instability in the banking system that is loaded up with treasuries and mortgage-backed securities at roughly 40 or 50% of current value is a recipe for disaster. You add into it a slowing economy, a crashing M2, tightening debt standards, and this puts more and more pressure on the commercial real estate, which, by the way, 70% of which is held by the regional banks, and the small businesses, which, by the way, 70% of the loans are held by the small business loans by the regional banks. More and more and more is being piled on top of the banking system. And for people just to go back to business as usual and ignore these warning signs just because everything's okay today really is a big mistake. And it's very difficult in my position or in yours to sound the alarm and sound authentic. I try my best to be authentic. I really do believe these things are happening. And quite frankly, I'm mystified as to why premiums have fallen and availability is better than it was a few weeks ago. In fact, I thought it would continue to decay and premiums would go to the moon by what we saw. But it's like, okay, we got this rush of over 13,000 clients in 30 days, approaching 14,000 out of nowhere. And now all of a sudden it's still busy, but it's relatively quiet. The premiums coming down today, to me, are just baffling. So I guess I would simply say it's as good of an opportunity to add to your position on availability, on premium, in an environment where, like that, things can change. And I expect them to change as we grow closer and closer and closer to the debt ceiling issue, which is just one of many things that I'm focusing on. But yeah, I mean, it's a sweet spot. Once again, it is a sweet spot. In this industry, everything that has been substantial or meaningful or that moment in time always happens with little or no warning. It happens on a Monday morning, or it happens just like at the snap of a finger. It happens, and you're left wondering, well, how the hell did that happen? How did it go from over here to over there just like that? That's what this industry has a propensity to do. And perhaps it's because really, you're talking hundreds of millions of dollars, maybe a few billion. That's a lot of money, but not that much money if all of a sudden that kind of wealth throughout the system seeks refuge. It would blow up the entire physical supply, and it would happen. And I think it will happen because the mainstream public at some point has to take initiative on their own and responsibility and say to their money managers or say to their advisors, look, you've done a great job all these years, but this is real. I thought maybe we were out of the woods, but it's real. And when that money comes into the marketplace, Chris, honestly, it will be the defining characteristic. And I think it's something people need to pay attention to, because if you look one step above, in the last few months, 230 or 40 million ounces were taken off the London Metals Exchange in silver on exchange for physical. In just the first few days of the May delivery contract for gold, 1.75 million ounces or somewhere in that neighborhood were taken off delivered. The exodus off of the big exchanges by the most sophisticated money, who's also closest to the information, continues. And when the big money continues to withdraw gold and silver from the exchanges, it will trickle down into the retail market like it always does. There's a little bit of a lag time there. And that lag time that we see right now, leading up to what could be chaos in a few weeks, should be a warning bell for everyone out there here listening to this, in terms of, if you're thinking of adding, don't wait for the price to fall any further. It may not. It may focus more on availability and what the biggest money in the world is doing. And their actions betray the price, betray the sentiment, betray the rhetoric. I think it really tells a story of where things are ultimately going.
Well, on one hand, do you think that's somewhat normal where perhaps maybe one way of phrasing it is that the demand was pulled forward when you had those issues with the banks and you had that surge in demand? And I also factor in sometimes that there's the silver crowd and then there's the rest of the world which sees a little bit differently. So perhaps to some degree, maybe the silver crowd came in and some degree also of new people came in and purchased, but got their fill over that 2 month period, and maybe that's why things have settled down now.
Yes, yes, I do. I think that's very intuitive and that's very smart on your behalf. But I guess in the back of my mind, I wonder what does it take for people to finally get it? I know you've dealt with that too. I mean, because what seems so obvious and logical to you and I mean, granted, you and I together have spent more time researching silver than really any normal people would ever do. And maybe that's why it just seems so normal to us. It seems so obvious to us. And I guess it's that is part of it. I just am wondering, and this is where all of my theory and thought about product not being available readily comes from, is at what point does the mainstream realize that the road to retirement just may not be paved with stocks and bonds and mutual funds and real estate the way we once thought it was? Perhaps there are forks in the road that require traveling down the silver road or the gold road. Perhaps there is wisdom in reevaluating even the best laid plans, because we are entering that, I think, that zone, or we already have, where if you aren't really reevaluating things right now and you just are going on status quo, if you are not really thinking about being a contrarian right now, I think you have an equal of chance of doing well as you do being a victim in a world where there are no guarantees. And it just seems to me that at some point, these very astute people who have become very successful in life, amassing large amounts of money through hard effort, and look, there's luck involved in a lot of things, but when you get to a level of great wealth, yeah, maybe luck was involved, but maybe not. Maybe there's a good deal of effort and hard work and stick-to-itiveness and intelligence and all of the things that go into where luck is opportunity meeting preparation. I mean, maybe these people who are successful in many ways in life will wake up and realize that the things that have worked in an environment where since 1982 interest rates have traveled straight down at a 45-degree angle, making all of these traditional assets seem really better than they are because of interest rate suppression. At some point, they have to take a step back and say, my God, this is not the same environment where I became wealthy in. This is not the same environment I grew up in. This is an environment where I need to reevaluate my best laid plans. And I just keep thinking, when does that happen? And we've seen little by little an expansion, a reluctant expansion into the mainstream. But I mean, for goodness sake, at some point, people have to wake up and look at alternative investments. And I would assume that time is drawing near. The only problem is that, in my opinion, of course, the way that the accumulation, this methodical accumulation, has happened by the big money using Western price suppression to run cover for it, is there will be no ramp up in terms of warning. I mean, this is the ramp up. This is the warning. And, if people don't prepare, they will be left out in the cold. And it's hard to convey that. It's hard to say that to people without sounding like a carnival barker. I'm not trying to do that. I just simply saying that, like I said, if I had $50 million right now dropped on my table here, what would I do with it? And the funniest damn thing in the world is I'd put it into gold and silver. Did you ever think there would be a time where you are actually questioning the safety of US treasuries or of the banks? And I think if you're not paying close enough attention. So where do you put your money in that environment? Do you think there's any coincidence that the central banks have bought more gold over the last 18 months than at any time in history? Or countries like India import 10 times, over 10 times the amount of silver is in the registered category right now. India imported in 1 year, or 230 or 40 million ounces in exchange for physical over the last 2 months, representing about 8 times what is backing the bars on COMEX. We are entering that period of time where the ability to continue to manipulate this market, which would be wholly stupid, as dumb as a mud wall, to try to suppress and go short on silver and gold that have fundamentals like they do, I think, like Ted Butler was saying, it appears that the commercial banks may actually be stop being short, that they have not come in as the price was rising and added to their shorts. He talks about a very big fourth trader, which he believes to be a managed money trader. Big Sweer says maybe it's Blackstone. Who knows who it is, or BlackRock rather. Maybe it is, maybe it isn't. It really doesn't matter. The point of it is that the commercial banks haven't followed the same playbook they always have, and that is add short contracts to a rising market. This new trader is, and it's very dangerous. If all of a sudden the price spikes, your loss potential when you go long is your whole investment. Your loss potential when you go short is everything times infinity, in theory, until it's closed out. It'll bankrupt you and everything you ever had, and your future generations. The point of it is that who would be short the level that these traders are in this environment in silver right now? It's madness. And when you see the registered category go below 30 million ounces to 29 and change, it's only the third time maybe in history it's happened. The first time since 2017. There you go. And 29 million ounces, that's just a very small amount at 5,000 ounces per contract. It's nothing. So there's 6,000 contracts that are available, and I don't know what the open interest is, but I'm guessing it's way more than that. And so how could you really think that this game can continue to go on indefinitely? And I think we're reaching that point where it's getting there quickly. And I think that's what I've been trying to say to people, is that you can't look at the here and now. You got to not look at the tips of your skis. You need to look out in front of you. And if that chart doesn't say everything, I don't know what does. And pull up a chart of the silver stockpile at the LBMA, and it's the same thing. So how much silver really is there for these banks and these traders to continue to suppress the price without getting called on the carpet? And that, to me, is why it will be a period of time where, bang, they just let it go. They stop shorting it and the price spikes. And there you go. I mean, look at that. That's just unbelievable how much silver has been bled down. And of that silver, how much of it belongs, and of that gold, to the ETFs, a good portion of it. So, the shelves are almost bare. And it's interesting, too, if you look at the LBMA, 95% or so of the zinc was taken off the exchange last year, 70% or so of the aluminum taken off last year. There are very smart, very sophisticated investors who are looking at the big picture, looking out way past their skis, and they're grabbing things that have real value. And I think this is something that if you're not looking at things this way, you're just looking at the price, you're being misdirected the way that these traders want you to be, by misdirecting price and throwing everyone off the scent.
Yeah, and here we have the chart that you mentioned about the LBMA holdings with the ETFs just under 18,000 tons, and then the green portion just under 9,000 tons for what is left over out of there. And Andy, you had some good points there, although it reminds me of a conversation I had with someone last week who was saying, yeah, there's the de-dollarization and so forth, but if you go to someone down in Argentina where they're still using the dollar as a reserve there, to him it seemed really far away. When is that guy going to switch to an ounce of silver, just because of the way the system does currently work and the degree to which we have this dollar as a reserve currency? And while there are things underway that are attempting to challenge that, right now, for that average guy down there in many countries, especially South America, leaves them in a difficult position where what are the chances of them switching over to gold or silver? Although my counter to that, and I'd be curious to get your opinion on that, is that maybe in South America, in a place like Argentina, that could be a bit of a stretch right now. Although if you look at some of the BRICS countries that are actually already moving forward with some of these plans to de-dollarize, I mean, I think there you have a situation where infrastructure is building and being moved in place. Saudi Arabia, trading for oil outside of dollars. A lot of these things, and I don't know, maybe it does need that to start at a governmental level. I think some of the people who aren't necessarily studying currencies or the Federal Reserve or what's going on, maybe when it becomes policy in some of those countries, that's what could change that. So curious if you had any thoughts on that one.
Well, South America is on the BRICS hit list. I mean, obviously with Brazil there, but and the deals that were just struck between Brazil and China to use each other's currencies. But this is what China is doing. They're coming in to countries like Argentina and Brazil, and they're building infrastructure and oil rigs and oil refineries and ports and railways and bridges and tunnels and everything they need to be successful and to be industrialized. When you talk about the benefits of it, look at a country like Ghana, who just a few months ago they stopped taking dollars for oil and instead were trading oil for gold instead of the dollar. And in just a very few months period of time, their inflation rate has gone from 156% to 60%. Now, it's still huge inflation, but it's dropped by almost 100% just since they stopped using the dollar. And so, yeah, I think that there is a push away from the dollar, and it won't happen until it happens all at once. This is a once in a lifetime chance for these developing nations. All of these countries that are signing on to the Belt Road, to the BRICS, to the Shanghai Cooperation Organization, or the Eurasian Economic Forum, all of these countries that comprise north of 80% of humanity, they will not make the switch totally away from the dollar until all the pieces are put into place. But you are seeing a lot of countries that are doing unilateral deals with one another, sidestepping the dollar. But you're right, until it switches, it won't get mass adoption until it is time for the masses to adopt it. They're doing this in a very methodical way. The pieces are being put into place. You mentioned a country like Saudi Arabia. Look, every one of the BRICS players or the OPEC countries are on the Belt Road Initiative. At what point does Saudi Arabia, who has now joined the Shanghai Cooperation Organization, which is the largest financial and military organization in the world, they're already signed a military agreement with Russia. They're in essence being protected by Russia and China and the rest of the BRICS countries to whom they've applied. At what point do they flip the switch and say, we're no longer taking dollars for oil? And what kind of ramifications does that have on a Monday morning? Again, there will be no warning and it will just happen. But when you get the president of Kenya, like we talked about before, not only selling his oil or buying oil from the UAE and Saudi Arabia in Kenyan shillings, but saying the market will be very different in a few weeks. You better sell your dollars. At some point, those kinds of things come true when you see more and more and more and more and more countries adopting this type of trade agreements away from the dollar. I mean, right now, 30% of the G7 countries are sanctioning 30% of the countries in the world. I mean, the sanctions by the G7 and by the US are pushing away the rest of the world at an accelerated pace. And so you're right. Until it happens, it is the way that it is. But I have a feeling, just by looking at all of these countries and all of the evidence pointing to these countries getting ready to do that, until it happens, it's status quo. After it happens, you're screwed if you haven't prepared. And that's how it's going to play out. And I think that's the way that these countries are playing it. They don't want to be on the wrong side of this. If they jump the gun, not in unison, before before this happens and face the wrath of the US, I think when everyone is ready to do it, when all of the pieces are put into place in terms of agreements, in terms of how oil is sold, in terms of military agreements, in terms of aligning interests, they won't. And it's going to be, more of the same until just like that, it changes. I really believe that is the game plan. And, Mike Adams calls it Operation Sandman, where over 150 countries have agreed at that moment to dump the dollar as the reserve. And what is the trigger? When does it happen? How does it happen? The only thing that I would venture to guess on is that it happens again on a Sunday night. You wake up Monday morning to a whole new reality. So, to your point, it's valid until it's not. And I just think that we're heading towards the it's not portion of the equation in a speed that is accelerating faster than I would have thought.
Yeah, I hear you. And fascinating how at the same time, as you mentioned, with the declining inventories, so a couple factors at play, and wonder how that will all combine together. And I suppose we'll just keep an eye on it and see in the coming years or months, perhaps, especially as it now does appear that the Fed, at least the market's pricing in that they have done their last interest rate hike. And we will see. I'm still curious to see whether we get cuts this year. I think it would require a bit of an event to happen, which is one of those things that we thought was going to happen last year. Didn't. In March and April, it happened to some degree. And
but look at the debt ceiling issue. Janet Yellen says dozens of banks will fail if it happens. We're that close, and it looks like it's going to happen. As far as I'm concerned, when you look at the 6% on the 1 month and the credit default swaps, it's going to happen. That could very well be your event. Now, I don't know if we talked about something last week, and if we did, please excuse me. But I think in hopes that not everyone saw what I've been talking about a little bit lately, there are two things I want to mention just to add fuel to the fire about you can't make it up category. You know, there's a man named Jared Bernstein, and I don't know if we talked about this last Monday. If we did, I'm sorry, but I'm going to say it again because it's very important. He wrote a report that was picked up in the New York Times in 2014 called King Dollar No More. In it, he advocates that the U.S. must actively take steps to dethrone itself as the world reserve currency. And he gives all sorts of reasons centered around financial bubbles and trade deficits and all of these things that are a function of being the world reserve currency. Well, that in and of itself, a report that was written a decade ago really doesn't mean much, except he was just nominated by President Biden as the head of his economic advisory committee. And, you know, this is a guy that is openly advocating for losing the world reserve status. And then when you talk about the banks, you know, and the growing concern around the banks, the head of the IMF, and I'm going to butcher her name, Kristalina Georgieva, well, she blamed complacency on the U.S. banks and the problems there. And she said that even more so, she said, the rapid pace of recent U.S. bank runs, which were fueled by savers' ability to move money online with a single click, should require a lot of new regulatory thinking about how we deal with this. She said it is the speed that money can move from one place to another that goes into the territory of unthinkable, she added. So here you got the head of the IMF basically saying, no, if you can click a button and move your money out, that's too fast. They want to regulate the way that you are able to move your money in and out. And it becomes a whole hell of a lot more concerning and frightening when you realize that we are at the footsteps or the doorstep of a foothills of a central bank digital currency, where these kinds of controls and limits will be put into place. Here again, more reason to get the hell out of the system, to get out of the way of what is coming. And I think it's real. I mean, it's how many of these things do people need to hear before they take a leap of faith and trust their gut? Or do you just go down the rabbit hole with everybody else, hoping that everything turns back to normal? And I would venture to say that normal is something we may never see again in this country the way that we knew it. And you have to adopt and hope for the best, but prepare for the worst. And that's what this is all about. It's not an investment. This is wealth. This is wealth that the biggest money in the world is accumulating because they see something coming too. They're just not being very vocal about it, and they're using the suppression of the price in order to do it. And when you see something like this from the head of the IMF saying, yeah, we got to do something about people's ability to move their money with the click of a mouse. Well, if that doesn't scare the hell out of you, well, maybe the fact that the guy that is now the head economic advisor for the president is advocating losing the world reserve status. Or maybe the other economic advisor, Lael Brainerd, whose whole premise is removal of all of the banks, including the commercial banks, and being a full modern monetary theorist and dealing directly from the Fed to the public. So if everyone leaves the regional banks because they're freaking out, especially if a few more banks fail at the debt ceiling debacle, and everyone goes into the commercial banks, well, just what if those commercial banks fail with $50 trillion in derivatives by JP Morgan? All of the big 4 or 5 banks have massive derivatives. What if they all fail? Bang, blows up. Have no fear. We're here on the white knight horse to give you your new CBDC and make you whole. All you got to do is take it. Well, that would follow what Lael Brainard's theory is, and she's advising the president, along with this knucklehead who's advising losing the world reserve status. So from the you can't make it up department, I'll show you that the facts, you take it where you want, all of you out there. What does it mean that he wrote that report 10 years ago? What does it mean that Lael Brainard, this was her thesis when she was running for the Fed a year and a half ago? I don't know. You tell me. Is it something to be concerned about? I sure as hell think it is.
Well, that's my guess, as you can.
Yeah.
You can see.
Well, I mean, and that's there is no other way out, Chris, but that. There isn't, because what people don't talk about enough, yeah, they focus on a $31 trillion debt, and a trillion seconds ago was 31,688 years ago. But what about Medicare, Medicaid, Social Security, and government military pensions? Social Security is $77 trillion filled with IOUs. And Reuters says it'll be insolvent in 10 years. It already is insolvent. But between Medicare, Medicaid, government military pensions, and Social Security, you're at almost $200 trillion. How do you pay this stuff off? That's off the balance sheet. There's no way but to print. And it's inflation or default, one or the other. And Richard Russell, God rest his soul, was saying that almost 20 years ago, before all of this mess is what it was. He said the Fed has already crossed the line of either inflation or default. Inflate or die was his mantra. And at what point do people wake up and realize it doesn't matter what happens today, tomorrow? Look past your skis. How do you pay off all of these obligations as rates are rising? How do you pay off all of these obligations in a country that's sold off all of their manufacturing? I mean, we don't produce anything anymore. And so these are real things, and that's why inflation will be here. It ain't going anywhere. And so if you hold dollars, you are destined to go broke. Ultimately, no matter what happens next month or in 6 weeks or in a year, ultimately, either we default on our obligations or we print money, because I don't know how the hell you increase GDP to that degree to pay off almost 200 trillion in debt. That would be one hell of a neat trick. But ultimately, it's either print or default. I don't know, because I think we're entering a period of time where we've exhausted much of the good graces of our foreign creditors, like Japan and like China, who have sold 400 billion in treasuries over the last few months. They're not buying any, they're slowly selling them. Where does it come from? And that's Ben and his helicopter dropping $100 bills across the landscape.
Well, we could also get the default and print, not necessarily an either or. And
best of both worlds, right?
See how that goes. Andy, one last question before we wrap up today was going through the Silver Institute's World Silver Survey a bit more. Here we see these are the supply and demand numbers. Here's net physical investment. Last year came in at 332.9 million ounces, which is the high going back a decade. They have it falling off slightly in 2023. I'm curious, I don't know necessarily that you've looked at this in particular lately, but do you have any general guesstimate based on your sales figures this year? I know that it's been a bit of a volatile year where we've had some periods where it's been pretty calm and then pretty frantic and chaotic, but any thoughts based on what you've seen so far, whether you think we would have more or less physical investment demand in silver this year?
The only thing that I would say to that is that this year we've had much more interest in gold than we have in the last 3 years, much more. So maybe the interest in gold is taking away some of it from silver. I remember having talks with you saying 95% of everything was silver, and for the last 3 years it has been. So, almost every sale that we do has some silver in it, or it's all silver, even those buying gold. But I will tell you that gold has taken on a greater significance this year. and has been fairly dormant and insignificant completely over the past 3. That would be the only thing that I would say to counter that, is that some of the demand that would go into silver is also going into gold right now, because the size of the orders that we have seen so far this year are very large in many respects. Not all of them, but there are some very large orders. And you could have $1 million in gold in a briefcase and sprint to the car, whereas $1 million in silver is going to weigh a ton. So you have to, it could take you 6 wheelbarrow loads, and the car would be riding on the rims at that point. So look, I don't know. I think silver sales are still massive, and I don't know where they get up that number. But if I were going to legitimize it without digging into it just off the top of my head, I would say the demand by the public is even stronger maybe than it was last year. The only thing is that there's a greater interest in gold this time around. Silver has not been ignored. It's just not the primary 100% focus the way it has been for the last 3 years. It's just there's also gold in the equation now too.
Okay, that makes enough sense. And they didn't have necessarily a big drop off. They had going from 333 to 309. And again, we are only halfway through, and a little bit of a choppy, volatile year so far. So it will be interesting to see how that plays out through the second half of the year. Amazing. We're 4.5 months, almost 5 months, midway through 2023. Go figure that one. But in either case, Andy, in wrapping up, is there anything on special this week if people are looking to acquire silver or sell silver or gold, or anything though that's on special for people who are looking to?
Yeah, we're doing the 2023 Krugerrands at $3.99 over. They are in stock, ready for immediate delivery. It's a great choice. I love them. And mint boxes of 500, tubes of 25. We have been soft launching our website this week within our office, so it's becoming more and more a reality. Hope to launch it next week. Actually, I'm hoping, but we're getting there. So a lot of these things you'll be able to see online on our new site, which will have prices and much more information. In the meantime, just send an email if you'd like to get a current price sheet to arcadia@milesfranklin.com. Or if you're interested in the special, again, 2023 Krugerrands at $3.99 over in stock. And whatever it is, or if you just have questions, please let us know. We're happy to answer them and do what we can to make it a good experience.
Well, appreciate that. Appreciate you, as always, joining me for our weekly physical silver report. Give people some insight into what's happening there. And hope you just have a great week, and we'll look forward to doing this again next week.
Love you like a brother, Chris. Look forward to it, man. We'll see you soon. Thank you.
Well, thank you, Andy, as always, for this week's physical silver market update. Great to get an insight into what is happening on the physical level of the silver market. Hopefully you found that one helpful at home. And before we wrap up, would like to thank BlackRock Silver, who brought us today's episode. BlackRock, who is advancing its Tonopah West project, as well as Silver Cloud and their lithium joint venture with Tierlac Resources. And to find out a little bit more about how things are going at Silver Cloud, well, here's a quick snippet of Andrew Pollard, the CEO of BlackRock.
This is our project, Silver Cloud. We're also in an area right next door to Hollister. Hollister produced at an average head grade of 34 grams per ton gold. Midas, however, produced at a head grade of just under about 30 grams per ton, but it produced way more ounces. Now, Silver Cloud actually has a bit of both. Half of our project, if you cut it down to half, the eastern half is uplifted Paleozoics. Now at Hollister, the vein system goes east-west. It points directly at our project. In fact, we actually found 8 veins outcropping at surface on the northeastern portion of our project, and those veins go east-west. Well, that means that it could be the same system as Hollister. And most exciting, though, is that the other half, the western half of our project, looks a whole hell of a lot like Midas. Midas was bigger. Midas was a cash cow. And what's interesting about Midas is their vein system, the veins are oriented north-northwest. The veins are, the mineralization is the volcanics. They produced all of their stuff from veins that were about 1 meter to 3 meters thick. Well, guess what we hit? We hit about 1.5 meter vein system thickness, which is what they have at Midas. It was all in the volcanics. They averaged 30 grams. Our discovery hole was 70 grams gold, 600 grams silver. This looks like the extension of that same system or a parallel system, but our system's running the same way. It's hosted in the same rocks, and the grades are pretty stupendous by my point of view.
Well, there is a bit about the latest developments at the Silver Cloud project. Again, you can find out more about that at blackrocksilver.com. And thanks again to BlackRock for bringing us today's episode. I'm going to wrap up for now, but we'll look forward to seeing you again tomorrow.